Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. We have an incredible show for you today. We have Brian Bailey here. He is a CCIM, he's a counselor of real estate, and he's a senior matter expert for commercial real estate for the Federal Reserve Bank of Atlanta. Is here in Studio One. Brian, thanks for being with us.
Michael, thank you for having me. It's great to be back today.
Well, Brian, we love having you on the show. We've had you on the show a few times over the years. It's always informative, and but I guess we have to know that whose opinions we're really talking about here. Right?
Well, thank you. Yes, these are my opinions and not necessarily those of my colleagues at the Federal Reserve Bank of Atlanta nor the Board of Governors in D.C. But certainly they keep me around and they're still listening. So good news, yes.
That's good. So you track commercial real estate really for the Fed and kind of the Fed's commercial real estate guy, right?
Well, thank you. Yes.
Guru?
That's too kind. It's too kind. You know, as part of our safety and soundness, ensuring the safety and soundness of the financial system, I'm part of our supervision and regulation division, which is in the banks trying to make sure that, you know, the banks are sound and that the commercial real estate loans that they're making, you know, are solid.
Yeah. Well, let's start off with the big question, Brian, too. I think a lot of our audience out there is that where are we in the cycle? It seems like we've had a nice long run. How long is it going to last? Where are we?
Right, absolutely. Well, you know, it sounds like the question my kids were asking when we took our summer road trip. You know, are we there yet? You know, and we've been asking that for the last couple of years, and my kids will go on into infinity, I think, by you know, continuing with that question. And you know, it's a good question because, you know, we've seen a lot of dynamics, and you look at commercial real estate, there's some areas that are moving quicker than others. But you know, let's boil it down and look at the drivers, really. And you know, the first driver in my mind is job growth. And commercial real estate tends to lag job growth, but we're looking at job growth and we've seen nothing but pretty solid job growth for the last 4 years. Currently, we're averaging about 180,000 jobs created a month, which is certainly significantly above the rate that we need to keep up with the growth of population.
And unemployment's really low, right?
Unemployment has come down pretty significantly. You know, as far as the economic expansion is concerned, you know, we're in month 97. This is the third longest expansion since 1945. Certainly, you know, great news from that standpoint. I think, you know, 90 through 2001 was the longest at 120 months. But, you know, looking at that, you know, maybe the last 4 are applicable because the economy has kind of shifted more from manufacturing, more towards services. You know, the average of those 4 is roughly 96 months. So we're right at the average. And certainly, you know, modest growth continues to kind of look like it's in the cards for the foreseeable future. You talked about unemployment. Unemployment has come down very significantly. You know, last year we were talking about it, and I think the U3 rate was 4.9. Well, today it's 4.3. So certainly we've continued to see that improve. You know, I kind of look back to 2007 as my marker of, you know, are we at full employment? And, you know, 2007, the U3 rate was 4.6%. So certainly some good news there. If you say, well, let's look at the very broad definition of unemployment, we look at U6, you know, we say, you know, currently it's 8.6. Last year when we did the show, it was 9.6. So we've had another 100 basis point decline. We're seeing more people come back into the workforce because there are more opportunities. And then if I, you know, go back to my, you know, Brian Bailey bellwether of 2007, I don't know whether it's right or not, but the rate was 8.4%. So maybe we've still got a little ways to go. At the same point, you know, you look and you see a little bit more of maybe some dark clouds on the horizon. I mean, I'm looking at bank sentiment right now, and we've seen net loan demand according to the senior loan officer survey done by the Federal Reserve. You know, we've seen net loan demand kind of soften a little bit and turn negative over the last couple of quarters. So I'm wondering if it's a little bit of a blip or if there's a change in the dynamic there. At the same point, we have seen the banks over the last couple of years tightening their underwriting standards pretty significantly. I still think credit is available. At the same point, certainly the banks are kind of saying, we're a little bit more hesitant to lend, and that's showing up in their terms. And then I think lastly, you have to look at commercial real estate and you have to say, wow, where are we on the supply curve? And I think multifamily, we have pretty significant amount of supply coming online, continuing to be built. But then you kind of do a deeper dive and you say, wow, a lot of that is geared toward the luxury apartment segment.
Right.
And so maybe we have too much in that segment coming online right now versus workforce or affordable housing where very little has been built, and so we're probably behind the curve there. So I think it's segmented, and I think some of the luxury product, back to that topic, it is highly concentrated in some submarkets. You look at Midtown here in Atlanta, you look at the Gulch in Nashville, some of those places. We're seeing office and industrial pick back up. We're seeing building there as the demand warrants, more so industrial, but office I think is progressing. And then retail, and retail certainly is rather than overbuilt. Retail has the issue of just it's a change. We're seeing an evolutionary shift.
Yeah,
and that really indicates that it's an efficiency issue, or how are we using the space we currently have? And you see, some retailers that are struggling to adopt that change.
Yeah, and if you look at the kind of the top of the market in your cycle, and you look at the various property types, and I know you're kind of looking at the country overall, and you look at the property types. So do you say if you looked at the top of the market in this kind of expansion phase we're in, that maybe we've crossed the line in apartments, but where are we on the other property types?
Right.
Are we still moving up?
I think you're absolutely right. I think we're seeing some softening because we have supply is outstripping demand in luxury apartments right now. So we're seeing some softening there in occupancies as well as rent growth rates. Certainly the sky is not falling. We're not falling off the cliff yet, but certainly some slowing there. I think industrial, because of e-commerce, seeing a lot of it under construction, but the markets that I see are absorbing it and absorbing it very well. So certainly some good dynamics there. Office space, has been a little bit later to come back in this cycle compared to others. Part of it is the ramp up in construction costs, and now we've seen the market begin to tighten enough where we're beginning to see some of the early entrants in the speculative space beginning to do their development. So I think that's got a little bit of ways to go. At the same point, we know that densification, we're putting more people in the same or smaller square footage, and that's been a little bit of a headwind. And then I think you look at retail, and as we talked about, I think there are going to be areas, there are going to be pockets that are very well insulated because of the density of people, because of the type of retail, mix of retailers, et cetera. Then there are going to be areas where there's going to be some pretty significant struggles, and I tend to think that some of those pockets will show up more in the burbs.
Yeah.
I think also that we have to think about e-commerce the e-commerce providers have done a very good job at shifting consumer buying habits in commodity-related products. I mean, you look at the folks who've gone out this year. You look at H.H. Gregg, unfortunately, and they were selling appliances, which is an easily commodity type business, easily identifiable. You look at Sports Authority, sporting goods, another commodity-focused business, and the list just goes on and on. What does that mean for commodity businesses such as grocery? Obviously it has the nuance of the perishable part, which has been a challenge to figure out to date. However, we see a significant amount of resources and energy being put toward that issue, and certainly Amazon or Walmart or Publix or a number of those folks are trying to figure it out and adopt to what the consumer wants, and the consumer wants home delivery, in my view.
Yeah, and you talked earlier about underwriting and bank underwriting and how that's changing. So how are lenders looking at retail right now? Because a lot of retail is doing well. Retail is usually well-located real estate. Is that the property type they're kind of most concerned with their underwriting today? Or?
Well, certainly in my view, there's been a lot of focus on retail. Part of it driven by the dynamics, the number of retailers that have gone out this year, that have filed for bankruptcy. I mean, those levels look akin to not quite to where we were in 2010, but still, a significant number of retailers have gone out. At the same point, lending requires kind of looking forward.
Yeah.
And you think about it, if I'm a bank, I'm making a loan today that 3, 5, 7, 10 years down the road impacts my balance sheet. Certainly you're looking for that tenant mix to support that, the terms that support that. But I think that the banks are being careful right now and doing a lot of analytics. At least my understanding is they're doing a lot of analytics right now, understanding how those portfolios look.
Yeah, and you mentioned supply levels have increased in some of the property types, but to put it in perspective, what are you seeing for supply levels around the U.S. of new construction kind of compared to the 20-year average?
Right. So, I mean, if we look at apartments, the 20-year average is roughly 1.2% of existing inventory delivered every year for the last 20 years. If you look at 2017, the forecast is roughly 2%. So, I mean, we're 2/3 above that. So a pretty sizable chunk from, 2% for 2017 forecast to the 20-year average of 1.2%. We contrast that office, the 20-year average is 1.5% versus the 2017 forecast of 1.6. That's coming off of pretty muted levels, though, prior to those years. Industrials kind of returned to the 20-year average. And then you look at retail, and retail historically was about 1.7% of the existing inventory delivered every year. Right now it's 0.4.
Yeah.
So
that's already a good thing.
The retail developers are looking for some projects.
So industrial, I think, we did a show recently on industrial, and it seems like there's a lot of new supply coming online and a lot of spec, but when you look at the 20-year average, we're right at it in industrial?
Yeah, we're right at it, and you think about, 2 years ago we were 1.2% of the existing inventory being delivered, which is below the 1.4%, which is kind of the 20-year average. And I don't have the numbers in front of me, but I would argue that the levels are probably even more muted when you look at 2010 and 2011, the levels that were delivered then.
Yeah, well, that's interesting. Well, speaking of numbers, if you'd like to get some numbers on commercial real estate around the U.S., check out Xceligent.com. They track the markets in most every large city now. And we're going to take a short break. When we get back and ask Brian about banking regulations, about Dodd-Frank, about Basel III, and what we'd expect and the impact there moving forward, and maybe a little bit about tax reform and the 1031 exchange and what could happen there to impact the economy and commercial real estate. So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. We'll be right back.